right, what is up, traders? What's up, tycoons? Super excited for today's video. Really great one for you. Now, this right here is basically a market quilt blanket, all right? And what it does is it shows you the top performing and the worst performing sectors on a yearly basis. And we'll take a look at this, and it's often the case that you see rotations on a year after year basis. What do I mean by this? Well, take a look in 2019 and 2020. Energy was the worst performing, and then in 2021 and 2022, energy was the top performing. In 2022, right, we can see tech and communications down here at the bottom. And what do we see in 2023? Tech and communications there at the top. So we'll dive into that a little bit more. We'll talk about election years, okay? This is very, very important, all right? Seasonality is hit or miss. A lot of people love it. A lot of people hate it. But the election year cyclicality and seasonality is one of the best and one of the most important to pay attention to in my time. All right. And then we'll also talk about the performance after an 8-week win streak. Basically we had 10 of the last 11 weeks in the stock market have been green. And we'll talk about some of the historical data for that as well. Now, as always, the content provided on this channel is for informational and educational purposes only and is not intended to be relied upon as legal, financial, or investment advice. So please be sure to read through the disclaimer. And if you're new to the channel, I started a completely free newsletter for you guys called Investment Intelligence, giving out free, valuable finance content and free trade ideas every single week. This is what the trade ideas will look like, highlighting the conditions on the chart, whether it's indicators, moving averages, levels, chart patterns, and showing you the chart itself, okay? How many of these trade ideas have worked out very well. You can go and take a look at, some of the previous newsletters because there is a website associated with it. So for free, you guys can go back and check out all the different trade ideas. Not every single thing is wins. I'm not claiming to be 100%, but I am, claiming to give you guys really high quality setups. Okay, so you don't have to worry about me spamming your inbox every single day with 5 to 10 different trade ideas and then just bragging about 1 or 2 that worked. Okay, I try to limit it to 1, maybe 2 a week, just to give you guys those high quality setups. Right now. RTX was one of the most recent ones, and you can see people in the Discord hitting me up about RTX, saying their January call options went up 88%. They actually went up over 100%. And to get access to the Discord, that's where you can get all of the different trade ideas, all of the different analysis, rather than just 1 or 2 a week from the newsletter. You can join for just $1 right now. So you can get in for just $1 using promo code JAN24, and that's where you'll get all the different analysis, all the different trade ideas, intraday commentary, as well as other valuable resources. Okay, now let's go ahead and start off here. And I kind of already gave you guys the gist of it, okay, is, what we're looking at is the top performing and worst performing sectors year over year. And, it's no surprise that energy was, top performing in 2021 and 2022. And in 2023, we see energy was not a strong performer. Okay, that's just kind of that market rotation. So it's a new year now, guys. Now is when a lot of hedge funds, a lot of institutions, they're planning their thesis, right? There's a narrative. Every year there's a narrative, and that narrative changes throughout the year, but that narrative begins now, right? And, that's what you need to pay attention to is, where's the area where the narrative could be different in 2024 and where we could see something that was an underperformer last year actually be an outperformer this year. Okay, you can go back and take a look, and many, many times this tends to be the case, right? 2011, you see utilities, biggest winner. Then 2012, this is the biggest loser, right? All right, it's very common. Then the next year, biggest loser, and it goes to biggest winner, right? And you see this type of rotation all the time, and it's very common to see this. And even if you listen to a lot of analysts speaking right now on tech, okay, on big tech, on CNBC or other platforms like that, they don't think that tech is going to lead the way this year, right? They don't think that it's going to be the top performer. So if that's going to be the case, well, where are some of the other areas you may want to look at, right? Well, we saw that utilities, consumer staples, energy, those were the biggest losers of 2023 compared to some of the others. Now, that doesn't mean that they're going to be the top winners, okay? If you take a look, consumer staples has never been on top. Utilities has been on top a couple times that we highlighted. And energy is very cyclical, right? And has a lot to do with geopolitics and geopolitical tensions. There's a lot of that going on right now. So, it's possible that energy might be a good play this year, but we'll really have to see ultimately price action leading the year hasn't looked too great. Here recently over the past month or two for energy, and we'll see, if that narrative changes throughout the year. But I really just think that this is a great visualization for you guys to see that, hey, the top winners, maybe they win 2 times in a row in a year. You see tech led the way twice here, energy led the way twice here. But it's not like every single year you can just expect tech to outperform every single sector, right? Often it's the case that it's the top performing, right? If you do a little bit of simple math here, 1, 2, 3, 4, 5 times since 2009, it's been the top performing, but there's a lot of years in between where it's not the top performing. Okay, so with a lot of people saying that tech's not going to be leading the way, it's time for you to decide or try to discover, what could potentially be the biggest winning sector this year coming up. Now, plenty of room at the bottom. All right, this is a question, by the way. All right, so if you take a look, the median stock is only a few percentage points away from its value at the time of the S&P 500's last all-time high at the end of 2021. However, about a quarter of stocks are still trading more than 25% below their values on that date. And so, basically what's that saying is that, there's a lot of stocks that were facing a lot of headwinds, with the high interest rate policy, with inflation, okay, and the stock market really was just punishing a lot of companies, right? If you weren't profitable and you did not have good earnings, then a lot of those stocks have been punished. And so essentially what this guy right here is saying is that, hey, there's still a lot of stocks that are beaten down and got beaten down to a pulp, right? And I'm just going to throw one out there, PayPal, right? PayPal got beaten to a complete pulp, and it's still very, very far away from what it was trading when the S&P 500 was at all-time highs. All right, it's very far away from its all-time highs. And that's just one example, right? Another one could be something like Zoom. Now, I'm not saying that these are the best companies in the world or the best companies in the stock market, but these are just some companies, all right, that are still trading far below their previous valuations, okay? And so if companies like these, if they can show some signs of growth, right? Because really what's happening is the market doesn't have any expectations for them, right? If they had huge expectations for these companies, well, then they wouldn't be trading at the values that they're at right now. So if some type of good news can come out for a lot of these companies over the next year, it's very possible that they can gain attention from Wall Street. And with that attention could potentially come rising prices as people say, hey, you know what, maybe this is actually a good value here. Maybe this can actually grow and maybe we need to pay more attention to it. So, that's kind of the concept that you want to focus on behind this chart. And then you can use this chart as a good example of saying, hey, well, what are some sectors that got beaten down last year where I could look and try to find good values, right? Find companies that I believe are still undervalued, right? This is a good way to start your year off while January is only about halfway through. Market's going to be closed on MLK Day. That'll give you, the rest of the weekend, an extended weekend basically to try to start diving into some of these different sectors, some of these different companies. Now, when we go into election year seasonality, historical data shows markets have tended to rise in presidential election years, with the S&P 500 recording positive returns in 20 of the 24 election years since 1928, which is basically 83% of the time. All right. Now, the average return for those election years was about 11%. That's well above the average return of 9.81% for all years since 1928. Now, what's really interesting is that the years that we, did not have positive years in the election years were also years that we had crashes. Okay. So it's a very divisive stat. It's basically saying, hey, the market's going to close green via historical data unless we get a huge recession and the stock market tanks. Okay. Now, I'm sure that that's how most people view it every year. Yeah, hey, we're going to have a great year unless we go into a recession, then things are going to tank. But when you try to eliminate a lot of the noise and you just narrow it down to that simple stat, okay, if you're someone who really thinks that the economy is about to collapse, right, and it's going to collapse within the next, within the next 12 months or sooner, right, then you're someone who honestly, this data set right here shows you that, hey, even though it's an election year, if we go into a recession, it's not going to be a good year for stocks. Now, if you're someone who doesn't believe that it's, that the economy is about to collapse and that we're about to go into a massive recession, then you should have, some pretty high hopes for the market, about an 80% chance odds that, the return is going to be somewhere around that average return for election years of 11%. Now, past performance doesn't predict future performance. All right. So, maybe the historical average is 11% and maybe the S&P only goes up 5% this year. Who knows, right? Maybe it shoots up higher than that and we have 18% returns in the market, right? You can't necessarily predict things to a T, and that's not what you should be trying to do, is to try and call the exact top or try and call the exact bottom, but you want to have some type of an overall thesis on your general view of the market. If you're bearish, why are you bearish, right? What's making you bearish? If you're bullish, what's making you bullish? And this is a good data set that you guys can use, if interpreted correctly, to help you form your thesis, right? Maybe you're bullish on the economy and you don't think necessarily we're going to have this big, massive crash, all right? But you see nothing but bear data. You just hear nothing but bears. Anytime you go on Twitter, anytime you go on YouTube, everybody's telling you things are about to crash. And it's a lot of noise, right? It's a lot of process. It's a lot to process. Well, this is good data for you, And if you're someone who is basically believes to the fullest that we're about to have a huge, massive recession, okay, then this is something else that you can use and say, hey, well, you know what? The stock market may not crash. My bear thesis may be wrong, but I know if we do get this recession, it doesn't matter what the bulls say about election years. Every time that in the election year cycle that we've had a recession, there's been a crash. So my thesis is even more right. Okay. I'm not here to tell you guys what to believe in and whether to be a bull or bear, but really just to present data for you guys. Okay. And I try to do it in an unbiased manner. All right. And if I do have an opinion on something, I'm going to let you guys know. All right. And I'm going to let you guys know, what my thoughts are. And a lot of people are scared to have opinions and scared to be wrong. I don't mind being wrong. There's nothing wrong with being wrong, okay? The greatest inventors in the world, they're wrong a majority of the time, but as soon as they get it right, okay, then it's a really big breakthrough, all right? And that's the way you want to look at things. You don't need to be scared of being wrong. You just need to try and work on your process. Now, if we go into some more statistical data here, all right, and this data is based after an 8-week win streak, so this will be basically a few weeks stale. But if you take a look, 1 month after the streak, all right, the market is typically up about 1.1%. So if you kind of factor in where we're at right now, we're not too far away from that. Okay, it's very close to being 1 month away from the initial 8-week win streak. If you count 4 weeks, all right, we're coming up on the 12th week right now. And if the market was to rally slightly, we'd basically be right around that historical data set. Now, 3 months after the streak, all right, you typically see about a 2.7% return. 6 months after the streak, you typically see about a 2.8% return. So what does this tell you? This tells you that somewhere along there's a bad quarter, okay, where maybe it's right after this ends, all right, and then you see a pullback, and then we see a rally, a recovery back to these previous prices, back to slightly above. Now, that's something that I kind of am thinking and approaching with the market, right? Is maybe I don't want to go all in right now at all-time highs, okay? Maybe I want to wait for some type of a correction, maybe a 5 to 10% pullback, maybe 10% or more, right? Of course, 20% or more is going to be a bear market. All right, that's the definition of a bear market. But the big risk with waiting, okay, is you have to say, well, I'm not going to buy things at all-time highs. I'm going to wait for that pullback. Well, let's just say hypothetically that the S&P 500 rallies to 500, rallies to 5,000, okay, and we were to get a 10% pullback from there, that would put things back at 4,500, okay, or 450 on the SPY. And if you're someone who's looking at it right now and you're waiting for a 10% pullback, and we're trading around 480, 479, 470s, your 10% pullback is going to be something that's closer to 410 or 420, right? And so if you're so married to a specific price and not wanting to buy at certain prices, that's something that can avoid you and hold you back necessarily. Is a good way to look at it, right? I mean, let's say you were coming in and the market pulls back to 460 right now or something, and then shoots back up to 500, right? Like we were talking about. all right, and then we get that 10% correction to 450. 450 and 460 is not that far apart, and so you could have just been waiting a whole lot of time for nothing, all right, essentially. So you do want to take this stuff with a grain of salt, all right. It's not going to perfectly predict what's going to happen or whether things are going to immediately rally or immediately continue higher. But I do think that somewhere in the first half of this year, I really wouldn't be surprised if it's February and March, that we do see a nice little pullback in the market. Now, here's the spinoff. If earnings come out really good, right, the market can continue rallying through earnings season. Right now, February historically isn't the best month in the market. So I am looking to see if that will continue to be true. And then we'll see how things move on into March, whether a potential sell-off from February continues or whether the market tries to find a little bit of a shorter term bottom. But this data set right here basically tells you that 3 months after the streak, we're going to be up around 3%, right? If this 8-week win streak happened in December, 3 months after is January, February, March, right? Let's do some simple math right here. Okay, and that's about almost 1% a month. So, historically, this should say that, hey, the stock market, going by this data set, is going to reach all-time highs, by March, right? And so the big question again is, do we rally tremendously ahead of that and then pull back, all right? Or, do we get the pullback first? That's basically the big question right now to me. 12 months after the streak, you typically see the average performance is 8.9%. Now, this lines up pretty well with the average return of the S&P 500, so no surprise there. And then you combine that with election year data. Now we got two data sets saying that, hey, based on election years and then based on what happens after an 8-week win streak, we have chances on gaining on average from 8.9 to about 11.5% for 2024, right? And that's not opinions. That's not an opinion. That's just data, right? That's just history. That's just facts of what's happened. So, things are looking more bullish from a historical data set point, but, a lot of the macro things are scaring away investors. A lot of the bears are very focused on the macroeconomics and, the economy in general. Something that I think was really great, Warren Buffett said once, or maybe it was Charlie Munger, RIP, but, they said that, hey, if you have an economist on your staff, you have one too many people on payroll, right? And so what this means is that, everybody with how much financial data is accessible via Twitter, via, just the internet, right? Everyone really thinks that they're a top level economist, right? And they think that they know something that the market doesn't, right? That Wall Street doesn't, because they've seen something on Twitter or they read an article about this, right? And at the end of the day, the macroeconomics are important, all right, and they can potentially give you an edge, but a lot of times they can also steer people in the wrong way and keep people from missing out on different opportunities in the markets. Now, most cyclicality measures are fading here at the moment, and so essentially what this means is that cyclical things that are oftentimes you hear Wall Street talking about, cyclical investments, right? Or this sector is very cyclical. This asset type is very cyclical. A lot of those are fading right now. Okay. So from a bear standpoint, this doesn't look good, right? The things that are cyclical have been dropping, right? And that's going to be what we've got here on the green line is going to be the transportation versus utilities. The purple line is going to be copper versus gold. And then the pink line is going to be discretionary versus staples, right? And we've seen all of these things fading really since about December 15th is roughly when a lot of these things peaked. And then we've started to see that pullback there. So, from a cyclical standpoint, it's like, hey, man, things don't necessarily look too good. Investors are selling these cyclicalities and that could be predicting or forecasting a bad view on the year, right? And so, this is why we try to differentiate a lot of, what is data, what does facts say, and then what do interpretations of the economy say, basically what people, analysts, investors, and others are interpreting the economy. What are they saying about it, right? And oftentimes these things can line up, right? And oftentimes, they can be very different, right? And right now we're seeing a little bit more bearish cyclicality, even though we have, some good historical data sets here suggesting that the market, will be positive anywhere from, like 8 to 11%. Now, from high levels of positioning, upside tends to be more capped, All right, and so what we're taking a look at is the average percentile of positioning and sentiment indicator. All right, left is going to be positioning more bearish, right is going to be positioning more bullish. Okay, and this is the S&P 500 12-month subsequent returns for different percentiles of our positioning and sentiment indicator. This is from Goldman Sachs. Okay, now if you take a look right now, all right, where we're at, and basically the max upside. When things are more bullish, and positioning is more bullish, the max upside is capped. Okay, when you take a look here, the max upside tends to be capped, right? And when everything is more bearish, right, that's typically when you tend to see larger returns. So, that's why it's very possible that the NASDAQ may not rally 50% this year, right? And that tech may not be the highest outperforming, because in 2022, positioning was extremely bearish. Okay, and that's also when the market bottoms, right? The market's going to bottom when things are extremely bearish. The market doesn't bottom when everything is extremely bullish, right? That's typically when things have already rallied, right, and they're already coming off of lows. All right, sentiment tends to follow price action. It's not a leading indicator. It can be used as as a contrarian, but oftentimes, when things are selling off, positioning is going to be bearish. And that's when you have a lot of upside potential. So, again, it's not like the market, we think, according to this, is going to have some huge, 20% returns, 30% returns in the S&P 500 this year. It's possible, but, sentiment has been definitely more bullish, right? And if you take a look at this, it's slightly over 10%. So that puts us kind of closer towards that 11.8% returns, that we could potentially have in the market this year, which is still really, really great. Okay, so that's kind of why we're going over that, showing that to you. Now, sentiment and positioning indicators have turned more bullish, especially for equities, right? So risk on is going to be over here, risk off is going to be over here, right? And you can see the current, basically where we're at. All right, and positioning is more bullish. All right, all of these are different, components essentially that make it up. All right, and so you can see the AAI. Bull versus bear. This is something that people use. Global equity flows, right? You can see, risk bond flows. All of that stuff is leaning more risk on, right? And that's evidenced by what you're seeing here, right? Remember, this is the risk on sector. This is the risk off sector. This is March of 2023 over here. Okay, and so yeah, we're pretty much just more risk on right now in the market, right? And so positioning more bullish, right? So these two charts kind of go in together with each other. That's kind of why they have the same color sets. And you can see here that the max upside is capped when things are more bullish, right? And when positioning and sentiment indicators are more risk on and more bullish, right? So you do want to keep that in mind. Is that that's not like it's some big massive sell signal, like, oh, hey, everybody's too risk on right now, we're going to crash and go down 20%. It just means that the upside potentially is going to be a little bit capped, right? You typically see those much larger returns when everything is extremely bearish. Okay, now these are more equity positioning indicators. It indicates that it's elevated going into Q4 earnings, which is a notable change relative to Q4 earnings last year. All right, and so that's what we're looking at here. All right, we have the S&P 500 in green, right, and then we've got the U.S. positioning indicator here in blue. Right, and what we can see, Q4 last year was down here. Okay, Q4 last year was down here, right, and Q4 this year is up here, right, and we can see that sentiment has had a big shift, in these, right, and you typically see these very large swings and very dramatic swings in the positioning indicator. All right, and obviously, as I mentioned, that's going to be because when people are, when price is going up, right, people are going to be more bullish, right? When price is going down, people are going to be more bearish. There's not really any secret sauce to that. Now, that pretty much wraps up the video. So don't forget to subscribe to the Investment Intelligence newsletter using that link in the description. Completely free, valuable, trading, finance content, as well as trade ideas. You can also join the Discord for just $1 right now using promo code JAN24. There's a link in the description for that as well. And If you enjoyed today's video, right, you can go to my Ko-Fi page, click on this buy a coffee button, and it's basically a way to leave a tip or donation. Right now, the Ko-Fi page has also got some other really great features. You can click on the commissions tab, and that's where you can book your one-on-one session with me. Right, I do a lot of one-on-one sessions. You can book a 30-minute or a 1-hour session, and we can go over day trading dynamics, swing trading strategies, interactive QA. Maybe you guys want some opinions on some option strategies and different option strategies that you can run. I know a lot of people come and talk to me about options, and I do a lot of options related things with them, teaching people how to leverage the shares that they own to essentially get, free hedges, doing all of that via options. So, feel free to check out the Ko-Fi page. There's a link in the description for that as well. And I will see you in the next video.